I'll be talking about how construction financing works. And so let's get into the presentation here. So a couple of things I'm going to be going over, the dream versus reality of construction and how construction financing works and some of the challenges that you run into, the major challenge, which I'll talk about a little bit. Primarily, it's cash. I'll give you a hint. How does it work? So I'm going to talk about the draw schedule, give everyone an example and kind of walk you through it. Go over the pros and cons of doing construction, a little bit on how to finance it. So how you can go through residential, commercial, and private financing. A couple of items about getting creative, some tips and tricks, and also talk just a little bit about some of the keys that are important for development financing as well, because it is a little bit different when looking at development. So, building your dream house, we have to say, I mean, we get this question a lot. A lot of people want to do it. Everybody would love to, of course, custom build their own home. The picture of, oh my gosh, I can build something like this and I can design it exactly the way I want. The reality is there's a lot of decisions. Anybody who has built their own home knows this. You end up getting into a lot of decision making. What kind of countertops do we want? What color this? What color that? Can eat up a lot of your time, also eats up a lot of your resources like money as well. So it's something that's really important. And one of the things that we actually run into, and the major issue or concern, is capital. Doing a construction loan is going to require a lot more capital than your typical purchase of an existing property or buying a property that somebody else is building for you. So these types of deals can be more difficult to finance. That is probably the biggest issue with construction. I'd have to say probably about, I'd say about 70% of the inquiries that we get for people wanting to build a property don't actually have the capital required to do so. So we have a lot of people that would like to do it, and a large number of those people don't have the capital available to actually do construction financing. So that's one of the biggest issues that we run into quite frequently. However, later in the presentation, I'll talk about a couple of different ways to get around that. So let me explain why construction financing is the way it is and how it works. Construction financing is based off of something called the cost to complete basis. And so basically what the lenders are doing is they're determining what the maximum loan amount is, and then they're going to release money in draws, and they're always going to hold enough money back to finish the project. And so if you've been approved for $1 million mortgage, and as they're releasing draws to you, let's say that you're finished 40% of the construction, they're going to ensure that if you're allowed to finance $1 million in total, and if you finish 40% of the project for $400,000, that means that $600,000 is still required to finish the project. They would release a draw to you where they're still going to hold back $600,000 of the approved $1 million to ensure that you have enough funding to finish the project. And don't worry, it's kind of complex, but I do have a spreadsheet that I'm going to show you a little bit later in the presentation and kind of walk you through stage by stage how the calculations work so that you can understand that. And yes, we do have a spreadsheet that we're happy to send over to individuals and walk you through how the calculations work. So the funds are released in draws. That's why they call it a draw schedule for anybody who's gone through a construction loan before. But the lender is effectively just releasing the money to you in stages. One of the key metrics or understandings here is the lender is always reimbursing you for work done on the property, not giving you money up front, crossing their fingers and hoping you don't go to Vegas with it. So there is ensuring that they're just rebating you and refunding you as you do work. This is very similar actually to a program called Purchase Plus Improvements, which is a really common feature that we use, especially for first-time home buyers. You can actually add the improvements on a property to your mortgage. So let's say that you're a first-time home buyer buying a property for $500,000. You can actually get the lender to add up to about 10% of the purchase price, so 40 or 50 grand, depending on the lender and the insurer, onto that purchase. And the lender could give you up to 95% financing of the improved value. And so it actually allows you to, instead of having to put 5% down on the 500,000 and then use up the other 50 grand in renovations in pure cash, which would require 5% of 500 grand, which is $25,000 for down payment, and then an extra 50 grand for the renovations, which is $75,000 in total. You could actually get away with putting just the 5% down on the total amount. And I should clarify that technically it's 5% of your first 500 grand and then 10% of any amount over $500,000 because the government likes to make things complicated. But even still, in that example, you'd be putting only 35% down or cash into your deal on the improved value. And in that program, just like construction, you're putting the value in and then get reimbursed once you put the value into it. So that's what they do within draws. Purchase plus improvements is always one draw. So you just improve it and then you get one draw of cash back. Construction by nature is released in multiple different draws. And so, yeah, you're putting value into the project and then you're releasing funds in draws to just continue to get you to the next stage. And once the construction is done, then they roll the mortgage into a closed term with the lender. So typically, most of the banks, then there's one bank and a couple of credit unions who will just give you a mortgage term, a closed term right off the bat when you get into the construction phase. However, most lenders, what they do is when you start construction, you go into a construction loan. Typically, that's interest-only payments on the outstanding amount that you owe. And it's usually prime plus, usually about prime plus 1% during the construction. And then once you're done the construction, then you go into a closed term, and that's usually where you get a better interest rate. So they're wanting to incentivize you to finish the construction as soon as possible. Frankly, the bank does not want to foreclose on you and foreclose on a half-built home. It's higher risk, and that's why the construction loans are harder to qualify for. That's why they're always making sure there's enough money set aside to make sure that they can finish the project with the extra funds they have not funded you in order to finish the project. And the banks don't really want to actually be buying a property and then finishing it themselves. They're not really in the business of doing that. So, foreclosing a half-built home is not something that they're super keen on, and that's why construction financing can be quite difficult to qualify for. So in general, most lenders go up to 75% to 80% loan to cost. And so I have used a different term than what you may have heard before. A very common term that you may have heard with financing is called loan to value. When you're dealing with construction, is loan to cost. Cost would be the land cost plus the build cost. So if you have a contract with the general contractor to build the house for $500,000 and the land costs you $600,000, then that means that the total cost is 1.1 million. They'd give you between 75 to 80% loan to cost in general on that total amount of 1.1. So let's just go through this. In general, the land draw is usually between 50 to 65% of the land value. That's typically what you can get on a land draw. There's the occasional time where you can get up to 75% with certain credit unions, but typically 50% is what most banks are comfortable with. Some days they can go up to 65. It's important to note here, if you do put a loan of 65% of the land value at closing, it often means that you just get less as you proceed through the draws. And so it doesn't actually necessarily reduce the peak capital requirements that you have in your project. It means that your next draw, you're actually going to get a little less because you still have a large amount that's remaining to finish your construction. So you'll find that getting more in the land draw doesn't necessarily help you with that situation. And that's why a lot of banks just say, well, if you can't do 50% down the land, then you're not going to get all the way through your project anyways. So what's the point? So that's something that's important to understand. Now, usually, and this is going to be kind of a general term, but usually have 4 draws during construction. Sometimes you're going to have a foundation draw, depending on the lender. They'll do a draw at 15% completion. That's usually when they've poured a concrete foundation, and you've got all your services hooked up to the lot line and everything. But typically, most lenders will do their first draw at the lockup stage, which is 35 to 40% complete. This basically means that all of your windows, framing, doors, etc., all in place. So wind could not pass through the house. In theory, is the way to look at lockup. Typically, then the next stage is electrical and plumbing roughed in. So that's usually with 65% complete. Finishing, so putting in the flooring, et cetera, is about 85% complete. And then full completion. So that would be usually about 100%. Typically, the lenders can actually fund the mortgage when you're from 95 to 97% complete. And usually that extra 3 or 5% that you're remaining is typically your landscaping. That's usually the last step to finalize a construction loan. So this is usually how you're going to see the breakdown. Usually a land draw. So when you purchase the land, you're putting between 35 to 50% down, and then you proceed through the construction phases. In general, to get a construction mortgage, you do need to show that you already have the plans, you have the budget, and you're getting approved for a construction loan right off the bat. If you're already in a standard conventional mortgage with a bank, you typically have to discharge, break that mortgage, pay a penalty, and then move into a construction loan. So construction loan is constructed differently, and it is a different pool or bucket of funds. And so you do have to break a mortgage if you're already in one, usually to go into a construction loan. So here's what's called a cost to complete worksheet. I took the standard one that banks use and then actually added in an extra step here. So I'll actually walk through this because this helps to understand this. And anybody who'd like a copy of this, you can email us at info@greenmortgageteam.ca and we'll be happy to send you a copy. But let's give you an example here. Let's say that the land cost is, if you look at the near the top left there, land cost is 400,000, building cost is 400,000. So the total lending value is 800,000. That's the cost that the lender's going to base their loan amount on. Let's say that lender's willing to give you 75% loan to cost, and so the approved loan amount is $600,000. And let's say that you're buying this, so there's no current debt. There's what's called a lien holdback. If you continue to look to the right here, lenders typically will ensure that there's a 10% of all the proceeds of the loan continue to get set aside for what's called a lien holdback. And that's because a lot of the time, once you finish construction, sometimes some of the trades don't get paid by the general contractor. And there's a time period where the tradespeople can actually register a lien against the property if they were not paid appropriately. And so a lot of the time the bank actually sets some money aside for the lien holdback and holds those funds until I think it's between 60 and 90 days has passed, and then they release the holdback to you. And so typically that lien holdback percentage is 10%, and that's usually what the lender sets. And in this case, I've indicated that we do want a vacant land advance. And so I've indicated yes, which means we're going to get some money at closing. And the land already owned, no, because we're purchasing it. So if I now look at the first one that says start, and we're 0% complete, we haven't advanced any money because we're buying the land, 100% of the construction remains. And effectively, if you look at the one that's highlighted here under available advance amount, that's $200,000, we're getting 50% loan to cost on the land costs right off the bat. So we're getting a $200,000 loan. And what I've added in here on the right hand side that's a little bit different than the spreadsheets that we usually deal with the bank internally is we're looking at what the cash position is to get you to the next draw. Okay, so what we've done here is we said, okay, you're at $200,000. Now the cost to get you to the next stage, and if you look at the next one, it says percent complete 40% because most lenders need you to get up to lockup stage, which is about 35 or 40% complete. Well, 40% of $400,000, which is the build cost, is $160,000. So if you've already put $200,000 into the project for down payment, and you need an extra $160,000 to get it up to what's called the lockup stage, then that means that your net cash position before you're getting your next draw is $360,000. Now, the reason I have this on the right-hand side is that it'll make sense as we go through the process. You'll be able to see what your peak capital requirements are throughout the process, so you can understand how much capital do I need in order to do this construction loan, okay? Because although you're doing an $800,000 cost, so $400,000 land, $400,000 build, and the lenders approved you for $600,000, you're in theory, it's that you're thinking, okay, I only need $200,000 for down payment. But in reality, because you're putting the money into the property first and then getting reimbursed throughout the whole project, you're going to end up with keeping 200 grand in the project, but you're going to have a higher peak capital requirement because you keep going up and down as you move through the stages. So we can see at the very far right, the net cash position is going to be $360,000. You put 200 grand in, you need to put 160 grand in, and then now you're at 40% complete. So now we're at draw one. Now we're 40% complete. We've already advanced $200,000 from the lender. We have 60% of the construction remaining. And so the cost to complete is still $240,000. The lender is going to say, we still need to keep aside $16,000. So you've already, the 160 grand that you've completed, we need to set aside 10% of that. And so the available amount to advance is $144,000. And so basically what they're looking at is, what's the total approved loan amount minus the amount they've already given you so far and the amount that is required to complete the construction. So they add all of that up and the amount available to advance is $144,000. And then you can see that we still need to put in an extra 100 grand to get up to the next stage to get us from 40 to 65% complete. So now our net cash position, after we put in 360 grand, we got back an extra $144,000. And now we need to put in 100 grand to get to the next stage. Well, we actually just received 144, and we need, of that 144, only 100 grand needs to go back in. And so now our net cash position went from 360 grand that we pushed out. Now it's been reduced down to 316,000. And you can see that this process continues. And so as you move through the stages, eventually you get to the very end here. And you can see that the bottom number for the net cash position, so that's row draw 4 and all the way to the right, it says $240,000. That's because at that point, that's really your down payment of $200,000 plus the $40,000 that you have in for the lien holdback, which you do get later, which reduces, again, you down to the total of $200,000. So I know there's a lot going on here on this spreadsheet, and this is usually the sheet that we spend the most time on when understanding how a construction mortgage works. And so I will actually take some Q&A and some questions at this particular moment, just because we have the sheet open. I just want to make sure that everyone understands this. So I'll check the Q&A and see if there's any questions in there right now. So far, I don't see any. I do see a question in the chat, though. There is a question from Dina. After the construction, would the lender considering rolling over the mortgage based on the ARV, which is the after repair value, and not loan to cost? So typically not, Dina. The lender will still use the loan to cost method in general. Every once in a while, we've found that sometimes lenders will have a policy where they'll be a little bit more lax on this. Most banks, however, after 12 months will allow you to refinance up to the market value. And so you may need to just wait for 12 months before you can refinance. So it looks like no questions on this. Everyone's good? Thumbs up. Awesome. I think that might be the first time I've presented this spreadsheet and there's no questions. So if questions do come up later, no problem. We can always circle back to this. And again, if you wanted to get a copy of it and play around with it, you can email us at info@greenmortgageteam.ca and we can go through this with you. Okay, perfect. Awesome. Okay, so next slide. Let's talk about the pros and cons of doing construction. Obviously, one of the pros of doing construction is you get to build it your way, and you get to save on the contractor markup. And so, because you're grabbing a contractor and they're doing the work directly with you, you're generally saving a little bit on the markup. Because if you just have a builder build for you, then there's less of a marketing cost. They don't need to find somebody that they can sell it to. There's generally a little less profit involved in that with them, because they're just building something directly to their specs and making a little bit of their margin on that. In general, and we talk about this a little bit later in the presentation, but if you're going out there to build a property to sell for profit, usually the profit margin is between 15 to 20%. And you can save usually a bit of that money by building it yourself. Maybe 20% of cost might be a bit much, but you can usually save, a certain amount of the markup by building it yourself, which is one of the pros. Another important thing is that you control it and you can own the land, build on it when you want at your pace. A lot of lenders do want you to build within 12 months if you're doing this, but you can always buy a piece of land with cash or using a home equity line of credit or something like that, and then wait a couple of years and then eventually build on it. And this is what we find a lot of clients do, especially for like vacation properties. They'll buy a nice piece of waterfront property that's vacant, and then they'll eventually build on it in the future. Obviously, there are some cons. There's a lot more cash required. A really general rule of thumb is you're going to need about 40 to 50% of the total project cost in peak capital. And so if we look back to that previous example that we had an $800,000 total cost on the construction, and our peak capital was up to $360,000. It was nearly 50%. I think that number ends up being 40%. So it's a pretty high number, and it's something, or 45%, I should say. It's a pretty high number, and so you need to consider that you're going to need a larger amount of capital to get through a construction project. It is harder to get financing in general because of the capital requirements, because of a couple of other things that I'll mention later in the presentation. It's just a bit harder to get financing on a construction loan. Another con is that you have to send an appraiser out every single time you want to draw as well. You have to now pay for an appraiser to show up to your home, say, yep, your home is now at this stage, send them back. And one of the biggest frustrations actually that we see is there's a lot of pressure for the homeowner to make sure that they've met the requirements and met the stage required by the bank to be able to get the financing. one of the issues we have is a lot of banks say you have to be at lockup. And let's say that the lockup is 40% complete. So you think you're at 40% complete, or you think you're going to be there in a week. And by the way, you have contractors saying, we need to get paid, we need to get paid. And you say, hey, I know, I'll pay you once I get paid. And then you rush it. You get the appraiser to go next Friday when you're being told by the contractor that it'll be finished by that point. And then what ends up happening is the appraiser says, yeah, you're 38% complete. Take that to the bank, and the bank says, sorry, you need to be at 40% complete or you don't get your draw. And all of a sudden you have contractors saying, well, I need to get paid, and you're in this really tough spot. It can be very stressful, actually. And so one of the things that we find is sometimes, for instance, certain lenders, especially private lenders, they're more expensive, but you actually determine the draw schedule in many cases. You just send the appraiser out. If you're 38% complete, then you're going to get an appropriate amount of capital based on that. Whereas with the major banks, they're a little bit more strict, and they say you have to be at lockup stage. And here's our definition of lockup stage. If you're not there, you don't get any cash for the draw. And so you have to get to that stage, which is something that can be quite frustrating for clients. Okay. So a couple of things on the financing and how to finance it. On the residential side, we're typically using banks, credit unions, and sometimes non-bank lenders, although I do find that the non-bank lenders usually aren't very good for these types of financing. In general, the best rates are available once you've finished your construction, and usually you're prime plus about 1% during construction. So that's what you can expect. Obviously, rates vary and change depending on the customer, the lender, and what rates are available at that particular moment. But in general, prime plus 1 during construction, then you get the best rate once you're ready to roll it into a finished product. You do generally have the tightest underwriting policies with major banks like credit unions, et cetera. It's very client focused. So they're looking at your personal income, your expenses, your debt servicing ratio, credit scores, all that stuff. And they're moderately property focused. So they generally prefer owner occupied. It is harder to get residential financing for building a rental property. That's usually something that they consider underneath small business or commercial lending. And so in general, residential, building a primary residence or a second home for yourself, you just have to be pretty airtight, income qualified. And they generally, you'll find, well, I shouldn't say generally, it's about half and half. Some lenders won't even use the income from a basement suite because technically while you're building it, you don't get any income from the basement suite. So you're going to find some lenders like TD to be fairly tight on that. And that, of course, changes all the time. Some of these lender policies will be more or less flexible at different moments. But this is something that's very important to understand, is that it just is more difficult to get financing for construction. On the commercial side, you're still dealing with banks, credit unions, non-banks, and obviously private lenders, which we'll talk about in a little bit. In general, however, the rates are more expensive. Prime plus 1 to prime plus 2 during construction is usually what you're dealing with on the construction side. You'll have fees of 1% of the loan amount up to sometimes 2% of the loan amount. There's more flexibility, however, with the income, so your credit score and income. They're a bit more property and project focused. And so they're looking more at the profitability of the project itself. They're looking less at you and more on your development itself. And so what is your profit margin? How many of the units are you pre-selling? Like some lenders, for instance, will say you can do 2 spec properties or spec builds at any time. Spec basically just means that you're building it and you're going to try and sell it while you're building or once they're completed. A lot of the lenders want you to have a certain amount of your units pre-sold. Some lenders will allow you to have 2 going at one time. Any more than that, you have to have the remainder pre-sold. So every lender is a bit different on this. This is where they're looking at you as an individual. What's your strength? And do you have a track record? Can you say, here are my last 6 projects, here are my profit margins, I successfully exited out of this one, et cetera. So they're not really looking at debt servicing as much, although sometimes, because there is residential and then commercial, you find that sometimes there is something in the middle called small business lending. Small business lending might be a little bit of a hybrid where they'll look a little bit more at your personal income as well as the income of the property itself in order to do these. And sometimes that can be a bit easier, especially if the profit margin isn't as good, or if you're a bit newer to construction and they're less, what's the word I'm looking for here? They're not as certain that you're going to be profitable in the project, and they're looking at what's the fallback here. What if you didn't sell it and you turned it into a rental? Would it at least cover itself? Or if it doesn't quite cover itself, then you have personal excess cash flow that could be used towards servicing it. Then there's private. So this is a mix, which are mortgage investment corporations or private individuals. And these are typically where you're going to see the highest rates, between 6 to 12%. Most of the time, construction financing is 7.5 to 8.5%. We find that interest rates have risen a little bit in the last 6 months, and so might even be pushing up to 9.5% now. Fees can really vary, anywhere from 2% to 5%. Most of the time, they're between 2.5 and 3. Minimal client underwriting, they're looking less at you as the individual and more at the property itself, and ensuring that, hey, if we have to foreclose on this, what are we lending on and how much are we lending on it is the question that private lenders always look at. So they're almost entirely property focused. They are more expensive, but they're definitely more flexible. You get to usually set the draw schedule. A lot of them don't require payments while you're working through the project. Instead of collecting payments on a month-to-month basis, instead what they'll do is they'll just look at the accrued amount of interest, and when you get a draw, they'll just take the accrued amount of interest off of that draw, and you just get the remainder. So much more flexible, I find, using the private lenders. Another thing that we use a lot and do a lot with private lending is if you don't have enough cash available for the build, especially if you own a home right now and you want to build a new home and you're going to move into it, but you don't want to sell your existing home until you've got the new one built, which is really common. Who likes to move twice, right? But if you don't sell the existing home, then you can't buy it, or you can't qualify to refinance your existing home and pull out enough cash to then do the construction loan because the major bank or a lender won't qualify you. This is where we may do an inter alia mortgage with a private lender. So we'll get a mortgage for the construction and they'll stretch it over your current residence as a second mortgage. And the reason that they do that is now between the two properties, they have enough equity to feel comfortable that if you didn't make your payments, then they have their basis covered between the equity of both properties. So this is something that we find is a lot more flexible. Jane has a quick question. So for residential financing, who's paying the mortgage broker? Good question. So in general, we find that as a mortgage broker, there are not a ton of options inside of the broker channel for construction financing. Banks don't really like to do them. They take a lot more time to do, and they're a lot more difficult to underwrite. And so they find in general that they like to push these into their small business divisions and whatnot, which are generally a situation where they don't pay mortgage brokers. So you will find that if you go directly to a bank, then you may not pay a fee. The problem is every bank has a very different policy on how they do construction financing. So I often find that with our team, we have a couple of lenders that do it inside of the broker channel, but we often say, look, I can do it inside the broker channel, but I have a better option over here that's even including my fee is going to actually be a lower cost overall in interest to you, or will give you more money. And so our team is a bit unique in that sense that we shop not just the 40 lenders inside the broker channel, but everyone, including lenders that don't have a broker channel, where we have a contact and sometimes as many as 3 or 4 contacts at any particular bank where we can figure out who's doing what. And I do find, especially construction financing, it does come in waves. Lenders have buckets or pool of funds, and construction loans are one of those buckets or pools that run out or can run dry very quickly. And some lenders, especially credit unions, can be really good for a period of time and then can run dry for a while. So in general, when you're dealing with a construction loan, it's more likely your mortgage broker might say, hey, look, we have an option, but it would include you having to pay us our fee directly, as the lender will not pay us our fee. Have another question from Haitham. Question about the value of the land the bank uses. If the zoning of land changes and the land value increases, would the bank use the purchase land value or the increased value? So it actually depends on when you get the property appraised. If you're buying it now and you're trying to get construction financing on it today, and the land value is $1 million today, then they're going to use the $1 million valuation as per the appraisal. If you buy it today and can close with traditional regular bank financing, just to buy a rental property, let's say, and then 2 years from now you apply, you get the rezoning, and now the zoning has increased the value to 1.2 million, let's say, because now you can build a duplex on it, and then you apply for construction financing. Well, if the appraisal now says the land value is 1.2, then you can get a land draw based off of a $1.2 million valuation. So it actually depends on what the appraised value of the land is at that moment. If you're buying it, then they're going to appraise it as is. And if you're refinancing it or doing a construction loan after owning it, then again, it's the same thing. You're still getting the loan as the as-is value of the land at that time. So let's get creative and look at other options and figure out, okay, maybe the capital amount is too high. How do I get into construction? One of the methods that we proposed before is hire a builder to do the build. And so instead of you going and trying to get financing on the property itself, and then you having to come up with the capital, buy the property, get the construction financing, et cetera, it might be easier for a builder who has a track record of getting financing with their own bank, maybe has more capital available, where you enter into a contract and you can even say, I want to buy this property. You talk to a builder, the builder says, okay, write up a contract, put up a sizable deposit, enter a pre-sale contract with them to buy the finished product, and then they go buy the land. And so now what's happening is you're just going to get your mortgage and it's going to fund when the property is built. So now it's like you're buying a pre-sale. You've basically just found the property you want. You have the specs, you have all the budget and plans and everything. And all you're doing now is getting the builder to buy the property. Now, what the builder is going to do is they're going to say, well, now that we're paying the financing costs and we're having to put up more capital, et cetera, they're going to have to charge a bit higher of a margin. So you're going to pay a bit more for it in this way. But it may be the difference between you being able to do this and not doing it, especially if you have a capital issue. Now, the builder will probably still want you to put a sizable deposit. You probably won't be able to do this with a small percentage. Most pre-sales, for instance, require probably close to 20% of the purchase price. You probably are going to expect to have to put at least 10%. We've done a few with 10%. And basically the reason for this is, what if the builder builds it and then you say, oh, sorry, financing actually fell apart, I can't close on it. The builder wants to be able to know that between what their costs were and the amount of the deposit, that they could fire sale it at that net cost to them and just get rid of it quickly, so they're not sitting on a property that they never intended on owning. So it's important for them to have enough of that security locked into the property. But essentially what you're doing is, now you're not getting the construction financing, the builder is, and you don't take title to the property until it's finished, and you have a pre-sale agreement to buy a finished product, and then you get a traditional mortgage on it. Another option is to either use cash or to use a HELOC to do the build. And so if you leverage other real estate, and you can go in and let's say that you have a home, you can actually get a construction, or you can actually get a home equity line of credit against your own home. Then you wouldn't need a construction loan approval for the purchase. You could just use your HELOC, buy the property, and then fund the construction using your HELOC. And that way you'll get cheaper financing, because typically a regular HELOC is prime plus 0.5%. Sometimes a lender will have a promo where the rates are even better than that. Then you're also not dealing with the bank for draws. You're just funding it as you go. And once you're finished, then you just refinance the property. So this is if you have available equity and you can qualify to get a home equity line of credit set up against your home, then this can be another easy way of doing it, and it's a way of reducing your costs. I want to talk a little bit about development deals, as these are a bit different than your standard home purchase and construction financing. And so, as I mentioned earlier, the financing is based more on the profitability of the project. That profit margin that they're usually looking for is between 15 to 20%. I have found, especially in larger projects, that this number is starting to compress, and a lot of the deals that I'm seeing now are between 12 to 18%. I know a lot of developers that won't do deals if it's not over 17 or so percent. But it is more and more challenging and difficult. But this is one of the key metrics that you're looking at. So if you look at your total costs, if your costs in total are $10 million, the lender's going to want to know that your total profit after all your expenses are paid, including hard and soft costs, are somewhere in the 1.5 to $2 million range, ideally. And so that's not something that they're looking at. And usually they want to see pre-sales on units, especially if you don't have really deep pockets and you don't have a really good track record at that bank. It's really hard to say what the exact percentage the pre-sales of the units are, but you can expect that in general, 50 to 70% of the units being pre-sold is what we often find, depending on the size of the development, the profit margins of the deal, the developer themselves, and whatnot. Something that we've been dealing with a lot lately is actually building a purpose-built rental properties. And so this is really cool, but CMHC, one of the ways of them funding and getting money into the system, I think that Canada, from a high level, understands that we have a bit of a supply problem. It's obviously exacerbated in certain markets like Vancouver and Toronto, et cetera. But one of the ways that they've decided to help the supply issue is it's easier for CMHC to affect demand side than it is supply side, because to change supply, they have to go to the municipal level and tell, City of Vancouver, you need to increase density. City District of North Vancouver, you need to increase density. North Vancouver, you need to increase density. West Vancouver, you need to increase density. It takes forever to try to set all of that up. Instead, what they can do is they can affect the demand side and say, okay, what if we incentivize developers to, instead of building purpose-built, or instead of building condos to sell, why don't we incentivize developers to build purpose-built rental properties? And there really hasn't been a lot of programs since I think about the 1970s to incentivize these types of properties to be built. And that's why a lot of the buildings in many urban areas are from the 70s, those standard rental buildings. And so CMHC is incentivizing developers by offering up to, most of the time it's up to 95%, but there are ways you can actually get 100% loan to cost financing for very specific programs. And you have to meet certain criteria. And so there's accessibility, affordability, and energy efficiency are the three criteria. And there's actually a point system that determines how you can get financing. You get up to a 50-year amortization. You can get loans that are actually cheaper than residential financing. There's a lot of incentives to look at doing that. And so that's something that's very, very interesting. And for those of you that are trying to transition into building purpose-built rental properties, is definitely a program that you want to look into, is the CMHC programs like the Flex program, et cetera. One thing I do want to mention to anybody who's looking at development projects, it is harder to get financing for bare land. That is a bit of an area that a lot of lenders the last, probably say 12 to so months, especially the last 6 months, have started to take a bit of a step back on. If you're pre-DP, so development permit, is very difficult. And if you're not ready to break ground, it'll be very difficult for you to get a bank to be a land lender. And so that's something that we're finding a lot more private lenders are really becoming the land bankers. They're the ones who are willing to finance that acquisition and that holding period until you can get through all of these stages through the city, and then eventually you can actually build on the property. So it is harder to get through all those stages. Something to keep in mind is that if you are trying to acquire land, you may want to talk to your bank, and if they're running into challenges, then we have other options too. Some credit unions come and go as far as having capital available, although a lot of them have been drying up lately. Last thing, applicants should be fairly strong with good experience in order to get decent financing on this. We do find a lot of developers end up having to go through the private financing first, and then once they've got a bit of a track record and have a couple of projects under their belt, it's a bit easier to take them over to major bank financing. So if you're doing your first project, it's more likely that you're going to need to go through a private lender, prove yourself first, or get a really strong cosigner to be able to go to a bank. With a really strong liquid net worth is the main requirement that they're looking for. So a couple of tips and tricks to look for. First of all, on the capital gain side, there's been a lot of talk from a government perspective on this, but I know a lot of builders and a lot of individuals will build their own home, and when they're living in it, of course, there's no capital gains on it. I know a number of people that do this over and over and over again, and they just keep moving over and over again. And every time they build a new home, which goes up by $600,000, whatever that margin is, there's no capital gains on the appreciation of your owner-occupied home. There are some question marks about the government cracking down on this and trying to say, hey, look, you can't do this 4 times in 4 years. You're obviously doing this for, as a business and claiming that you're moving into to each home. But that's one of the primary benefits. And you see a lot of people that do this where they build their own home, that 15% profit margin or whatever they're able to save ends up being basically tax-free money when they go to sell their home, and then they keep doing it over and over again. So that's one of the advantages to doing construction for sure. Again, you're saving on the costs because of the builder margins. You're able to trim that down a little bit, not completely, of course, because the builder still wants to have a bit of a margin there, but you're able to save a little bit on that. One thing I want to mention is that technically, your mortgage, if you have a regular mortgage on a home, a lot of people say, well, why don't I just get an 80% mortgage on a home, and then I'll refinance my other property, come up with a capital, and then tear down the house, and then use my HELOC on my current residence to build on this other home. You have to be careful. And technically, your terms of your mortgage do state that you cannot tear down the home without consulting the bank first. And in general, this is where they say you must move your mortgage from a regular mortgage into a construction mortgage, break it, pay the penalty and all that. So something you need to keep in mind is that technically you're not supposed to do this. And I know some people do it anyways. And frankly, with the way that the world works today, it's not like back, in the 70s or 80s where your banker probably drove by your home on the way to the office and back. Bankers are very centralized now. A lot of underwriting centers are based in, Calgary, Vancouver, Ontario, et cetera. But at the same time too, technically the bank can call the loan if you've torn down the home. I mentioned this earlier, but some lenders won't use rental income to help you qualify, which is one of the things that you need to be aware of. Lenders don't like financing the bare land. And so again, if you don't have plans and drawings and intend on building on it within a short period of time, then it can be very difficult to get financing on bare land, regardless of whether you're a developer or just a regular person trying to buy a property to build on it in the next little bit. One thing that I want to mention too is that there are some special programs for clients that are self-employed, et cetera, where you may be able to qualify for stated income or these other programs on a regular mortgage, but generally in construction, it's usually pretty rigid. It's income qualified only. So if you're self-employed and wanting to do construction, it can be more challenging because those programs usually don't exist on construction. So just be aware of that. So overall, I'm hoping that this gave you a lot of information to help you understand how you can build your dream home. If you have any questions, if you'd like a copy of that spreadsheet, you can email us at info@greenmortgageteam.ca, and we'd be happy to help you out with that. What I'll do now is I'll open it up to answer the Q&A, and we can talk a little bit about any questions anybody has, and whether it's construction related or not. I'm happy to hang out, answer some questions, and we can wrap it up from here. So I'm just going to open up the Q&A now. Okay, so I have a question about what happens when the builder takes more time to build? Who pays the interest-only fee on the construction financing? Okay, so in general, you just have to be making sure you're talking to the lender. If you're extending past the build period, which is usually about 12 months, the lender would usually extend you. And of course, you're still continuing to pay the interest. You're always paying the interest on the amount that is outstanding. And so you're still going to pay the interest. That there's no way around that. You just have to make sure that you're talking to the lender and being in communication with them, especially during COVID, like the height of COVID. We did have a lot of purchase cost improvements or construction files that were getting extended and took longer to close because it's harder to get trades or supplies. The banks are generally willing to accommodate as long as you communicate with them. So it's not the end of the world in general if that happens. Jane has a question. Who's the person to contact at Green Mortgage about residential construction financing? You send an email to ourselves and my team. I'm happy to if you want to send some more information over to me and I can assess your situation, I can get the proper team member to reach out to you. I do have a couple of team members that specialize in construction, depending on your circumstances. So I have somebody in my residential team, but I also have somebody who does a lot of our commercial and private lending construction as well. So depending on which direction that file might take, we'd be happy to point you in the right direction. So that's Kyle@greenmortgageteam.ca. How quick will the refinance take after the build is done and funded by your own HELOC? So if you do that method where I mentioned you get a HELOC in your home, a home equity line of credit, fund your construction, usually what we would do is we'd actually set up the financing and start getting the refinance approval done in advance of you being complete. So if you think that you're 2 months away from being finished on your construction, then we would probably say, okay, let's start the application now. So then by the time that you're finished the construction, we can fund it. You don't want to start getting the construction or the refinance done only once you're finished. It's better to start well in advance. You can technically start the application 120 days in advance of you being finished, but the reality is most projects get delayed and the lender will only hold the approval on the rate for 120 days. So we usually say a good time if you're about 60 to 90 days away from finishing. That's a good time to engage us, get the process started, and then we can make sure that we line up the dates so that basically the day that you're 97% complete, you can get financing and pay off that line of credit. What is the difference between buying a service lot and a house to tear down and build? Good question. So it's just a consideration here that if you're going to buy a house that's going to be a tear down, you're going to have that demolition cost you need to add into your budget, which is something to consider. You also want to consider, hey, maybe I can actually reuse these bones and just add more to it. And that may save you a bit of money if you can just tear it down to the studs and add to it. But if you're planning on just tearing it down completely, one of the benefits of buying a home that is in livable condition, and keep in mind, it has to be livable condition. If it's not livable, then very difficult to finance. But if it's going to take you some time to go through the process of getting your plans and drawings prepared and getting the city's approval, it can be easier because you can get up to 80% financing to buy that house that you're going to eventually tear down. You can get so effectively higher percentage financing and lower cost financing, lower interest rate. And you can sit on the property, and then when you're ready to build, then you can move it into construction loan. Whereas if you're just buying a surface lot, then you're probably putting 50% down. And if you're still a few years away from having your plans and budget and ready to build on it, you might have to be using a private lender, which would be a higher interest rate. So there are some benefits to buying a house, especially if your timeline is longer. If you're going to be building on it right away, then in theory, actually, a service lot is actually better because you're just saving on the demo cost. Question, can you obtain construction loan for a sixplex in Ontario? Yes, you can. So that's something that you can go through CMHC if you want to. It's a bit small for CMHC, and a lot of lenders won't do them because of the size. That's something that a lot of the time, instead of going through the CMHC program, we end up going through the conventional commercial construction programs, just because a lot of the lenders that deal with the CMHC loans are $5 or $10 million and up in general, as opposed to just standard conventional commercial financing, which can be $1 million and up. So, but yes, you can definitely obtain financing for a sixplex, and technically, because it is more than 4 units, you can go to CMHC. As long as it's 5 or more units, then you can apply for CMHC. Wayne has a question. Hey, Wayne, is residential/commercial for construction loans based on the property type? Example, 5 doors is commercial, or is it the lot zoning or entity acting as the borrower, or a mixture of the above? Yeah. So in general, it's actually a bit of a mixture, Wayne. So commercial, some things would go to a commercial lender if the personal borrowing power is not strong enough with the borrower. So if you're planning on building a property with the intention of selling, that typically is something we go through commercial. We've also done it before we go through commercial because the client's not strong enough, but the properties will rent out for enough. And so we position it that, hey, look, client's intending on selling, but if they don't, the properties would actually rent out for enough to cover themselves under what's called the DCR, debt coverage ratio, which in construct or commercial financing, usually the lenders want to see that the income is about 1.25 times the expenses. So some of these will position a deal commercially. However, if the property is commercial, so if it's 5+ units or it's up, industrial or retail or something like that, then it has to go commercial regardless. And so that's the first thing to look at is what are you building? Because the property type will determine whether it's residential or commercial. Basically, it's commercial unless it's 4 or less residential units, which means that you can possibly go the residential route. But there's some times where even if it's possible to go the residential route, you may need to consider going commercial because of borrower qualifications. So lot zoning and whatnot can make a difference. And also what your intentions are. If you're building to sell, then those are typically commercial loans. That is a business activity. That should be a business loan, not a personal loan. That's a question. If you use your HELOC on your primary residence and knock it down for a new build, wouldn't that break your HELOC mortgage agreement? Yes, it would. So the same example, Dennis, if you set up a HELOC, the example I was using was if you own one property already and you're buying a new property, and then you get a HELOC on your existing home to build the new one. But if you just have the one home, you get a HELOC on it, and then you knock it down to then build on it. Yes, you're in breach of contract. Will the lender find out about it? It's hard to say. But if you ask a lawyer, they'll say you probably shouldn't do it because technically the bank can call the loan back, and you'd be forced to go into a construction loan, or the bank might say, hey, you should have told us. You now have to find a new lender, and you might be forced to go to a private lender in that case. So something to be aware of for sure. That was all the Q&A. I'm going to go into the chat now and answer anything that was put into the chat that didn't go into the Q&A. So Jazz had a quick question here. What exactly does cost to get to next draw mean? What is the cost for next stage? Yeah, Jazz. So in that spreadsheet, The cost required to get to the next draw was the total amount of capital that you've put into the project already, plus the amount of cash you need to get into you get your next draw, which means if you already put in $200,000 into the project and you need to finish 40% of that project, was an extra 160 grand. Now you've got 360 into your project. So your capital amount that you've put into the project is up to 360, and then you get a draw, and then, okay, now you've received 144 grand, and now I'm down to here, and then I'm going to, again, have to put more money into it, and then I get another draw. And so your peak capital will vary depending on what that looks like. And so, yes, the spreadsheet was designed in a way to easily show you what your peak capital requirements are, or the capital requirements throughout the project, so you can understand that. Let's see here. I think there's another couple of questions that were answered in the Q&A. Joe has a question. If I already own the land, the lender will lend 50% of the land. Can I use that land draw to start construction? So let's say I own the land clear or have a small mortgage on it. So in theory, I can finish the construction with just the land draw. Does this scenario work? Yes, it does, Joe. So you can just get the land draw only. You can just say, okay, lender, I can get up to $1 million, but I only need 500,000 on my $1 million lot. Then you can just get that $500,000 land draw funded, fund your entire construction, and then wrap it up. You probably still would want to consider doing construction and breaking into draws, because what will happen is if you fund the full $500,000 in the land draw, now the interest on the full $500,000 will accrue. So you still may want to break it down into draws, because then you're only borrowing money as you require the funds, as opposed to borrowing all of it, paying interest on it, even on the money that you don't need right away. So that's one consideration. But yes, in theory, you could just borrow the whole amount and then use that to finish the construction, so you don't have to go back and forth for each draw. Another question: any idea the latest processing time for the MLI Select by CMHC? So that's the CMHC program they were talking about. Yeah, it's about 8 to 12 weeks right now. So for a while there was about 16 weeks. Right now it's about 8 to 12 weeks, so it's gone down a little bit. Most of the deals that we're looking at right now are 10 to 12 weeks though. So expect it to be quite a long process. It's not a quick process at all. It's important to start early for that. Awesome. Any other questions? Have I answered everything? Awesome. Well, thanks so much for coming out. I appreciate it. It was good to see all of you. A lot of familiar names and faces. So thanks for coming out. Looking forward to seeing you all at the next monthly session, which will be the first Wednesday of September at 7 p.m. So thanks very much for coming out, and I'll talk to you guys soon. Thanks. And yes, this will be recorded. Everyone that registered will get a copy of the recording in the next couple of days. Thanks, everyone. Bye.